Here's how I generally analyze and trade the markets, and is the core reason behind my 100% success rate over the past year calling out trades publicly, and the reason why many of my members believe I'm the greatest technical analyst in the world. Banks don't have a lot of moves, and the markets are fractal, which basically means that any pattern that it plays out on a higher time frame will almost indefinitely repeat itself on a lower time frame. So this could be a 1 hour, this could be a 1 minute. Now, because they don't have a lot of moves, we're looking for a specific pattern. The pattern is one that goes up, comes down, and it looks like an M. Okay. One that comes down, goes up, comes back down, and looks like a W. Both that have in common is that they break the previous swing high or swing low. So I think of it as like an N. Some people think of it as maybe a W because it's coming down. Or I think of it as like a lightning bolt. So if price were to come down, let's see like this, and then create a W, what we're looking for, and maybe a wick down here, what we're looking for is we're going to be patiently waiting for a retracement, okay, back into a block down here, and we can refine that later on, okay, to buy back up for a bigger W. These are some of the most powerful moves you could ever find. Alternatively, if price is coming up, and this works on all time frames, by the way, and pulls one of these deals, we're gonna wait for it to come back up into this order block, and I'll teach you later how to refine that so that we can take a continuation with the break in structure that occurred here. Again, one of the most powerful moves you can find. Now, your higher time frames that are moving along like this are gonna have a smaller time frame in the fractal nature of the market. So in a 5 minute over a 4 hour period is gonna have a ton of candles. So we need to be certain that we're paying attention to the higher time frames and how they're breaking market structure. That's why it's useful to have different time frames to be looking at when you're analyzing the market, such as the 4 hour, along with the 1 hour, and along with the 15 minute, or the 1 hour, the 15 minute, and the 5, or even the 15, 5, and 1. It all depends on your style of trading. There's no right or wrong way to trade. If you only want to snatch 5 pips, snatch 5 pips. But on the higher time frames, it's going to look a lot different on the smaller time frames, okay? And you're going to be able to catch and fine-tune a lot more precise entries when you're trading with the higher time frame. Now remember, the market is fractal, so if we see on a higher time frame something like this, and there's a break in market structure, and we decide we're going to wait like this on a lower time frame to enter the marketplace, what you're going to find is that, let's say on the 1 minute, you're going to see that it's going to do a W, and then it's going to start trending up. And then you're going to see eventually that on the 5 minute, it's going to do the same thing, and it's going to begin to follow the same fractal. And then on the 15 minute, it's going to do the same thing, only it's going to be bigger, and it's going to copy, and so on and so forth. This will give you a awesome insight into when the market is going to shift. So when is the break valid? Well, the markets are fractal, so we need to make sure that it goes at least 50% or deeper, and it will actually mitigate. So let's say price comes down like this, creates a break. We want to see a deeper mitigation, around deeper than 60, the usual fibs. We want it to see really close. So over time, price comes down and there's a rejection. That's great. Now we want to see somewhere around here, about a 50% retest. And by then, she should be gone. So if you're patient and you wait, this would be your entry. This is useful information to know, because if, let's say, price pulls away, comes back down, mitigates, and takes off, when it takes off, if it were to do something like this, we know that the final point of mitigation would be down here. So eventually, when it did a break up at top like this, we could trade it all the way back down to that mitigation before it ping-pongs, probably to come mitigate back up to here. So you can see here that this was mitigated not 50% yet. This wasn't mitigated 50% of these breaks. So we know that when price is going to touch here, which is above the 50% mark, and it's in this order block, and we'll talk about order blocks in a moment, that price most likely is going to come down to this mitigation point. So as the new legs are developing, you can begin to find different mitigation points to trade from before eventually there's a breakout, a retest, or a head and shoulders pattern. Now, there's a lot of confusion surrounding order blocks, but they're really simple. When you see this pattern, this last leg is the order block. When you see this pattern, this last leg right here is the order block, okay? And as you zoom into the smaller time frames, these order blocks can get honed in smaller and smaller. Just remember, the smaller the time frame, the more inaccurate they become. With this information for intraday traders, you can use this to capture easy moves. Suppose today the market decided to do some stuff like this. It mitigates, breaks. We know that there is an order block here, right? That was never mitigated since nothing came back 50% anywhere around this area. So we know that if it were to come down here, there's a likelihood that price were to bounce and continue on in through the night and into the next day. So this would be your entry on a buy. Now there are more advanced methods to this, and I want you to know what they are. Imagine that there was a wick here and a wick here, then this whole push would be your order block. So you'd be looking anywhere in this area for signs of reversal. You can do that by looking at the lower time frames and seeing like train tracks, for example, or you'll see something similar to what looks like train tracks, but it's got a little doji down here. Sometimes you'll see maybe perhaps a hammer, okay, or the hammer is inverted, okay, up at the top. All of these signs are great signs that price is about to reverse. Again, we're not just trading off of the candlesticks themselves. We're remembering that on the 1 minute, if the candlesticks decide to come down and then create this break in structure, then it does this on the 5 minute. In the same respect, we note that in the 15-minute respect, there's probably a high likelihood that it's going to follow the same pattern. Now, your trade timing is the most important. You want to make sure that your setups are occurring at the Asia, the London, the New York, or the New York Stock Exchange Open. This will give you a high probability that a reversal is about to occur. The markets usually like to play on the highs and the lows of the past couple of days. Here you can see in this example that down here is an order block. We got a high and a low. This is at or around or below 50%. So we know that if price were to break down into this order block, we would be looking for a buy back up to a mitigation area, which, let's say this broke here, we could say that this was an order block. So for the day, if we were to see price come down here first, we could buy back up because we would be expecting a mitigation down here. If price were to come up here first to mitigate, then we would expect it to come back down into this zone for a mitigation. So be sure to keep in back of your mind that the markets do play on the highs and the lows of the days. Okay, see, and they go back and they'll play on the lows, they'll come right back up, play on the highs, maybe perhaps break and continue, or maybe break and continue. Okay, so patience is the name of the game sometimes. Now let's talk about points of interest. First, we need to understand the difference between a protected point of interest and a point of interest that is going to be a launch pad for a continuation or a reversal. The protected points of interest, again, are these interests, these highs where they break in structure and create an order block. Same thing down here, it's these lows where they break this and create an order block. These are your protected points of interest, the last point before price starts making new highs and new lows. other points of interest are final up push candle bodies of the candle. So if prices were coming down, let's see, we got candles coming down and there's a little doji here, okay, and then price decides to make a high, come back down, and then make another high, okay. Our protected point of interest is here. You can see that it mitigated the top portion of this with a wick, for example. We'll come down and wick and pull away. This is when we're gonna wait for price to come down to mitigate somewhere around the 50% area, which sometimes is usually a wick immediately to the left before. Now, the general point of interest that I'm usually looking for is if price were coming down, creates a little hammer here, and then it decides to create, let's say it comes up, breaks this high over here. We know that I'll be setting a point of interest here at the top of this candle, typically waiting for price to come anywhere within this order block to show signs of reversal before continuing at this. Remember again that when price is creating structure and pulling away and there's no mitigations going on 50% or deeper of these legs, it is inevitable eventually that price will come back down for all of these, and these will not be any kind of points of interest. We also have our last points of interest. Let's say price is coming up and it breaks, comes back up, okay, and it decides to mitigate and then break, okay. Our last point of interest is going to be at the bottom of the body of this candle. So if it looked like this before price reversed, our last point of interest would be at the body of that candle. This becomes useful because at volatile times, if we look to the left and we notice that we're in an order block and we're showing signs of reversal, we can buy right back up to that mitigation point and capture all of this with a very tight stop. New to trading, don't worry, everybody starts there. You just have to go and search out looking for a high leverage broker. You just want to make sure that they're an ECN account and that they can handle per trade the amount of liquidity you plan to trade. But don't worry, it takes 10,000 units to move the market with one pip. You're just a tiny pebble in a huge ocean. It might also be wise to select a variety of instruments to trade. And there you have it. That's how I generally analyze and trade the markets. Please only like, share, and follow if I earned it.